In 2008, while the S&P 500 crashed 37%, one sector was only down 15%. In 2020's pandemic crash, the same pattern repeated. What's the secret? It's not luck. It's consumer staples. And by the end of this video, you'll understand exactly why smart investors load up on these stocks before every recession. I'm Olivia from the Money Compendium, where we break down finance without the hype. Today, we're starting a 7-part series on recession-proof investing, and we're beginning with the foundation: consumer staples. No fluff, no get-rich-quick schemes, just the real strategies that protect wealth when markets fall apart. First, let's get clear on definitions. Consumer staples are products people buy regardless of economic conditions. We're talking about toothpaste, toilet paper, cereal, soap, and diapers. When you lose your job, you might skip the new iPhone, but you're still buying groceries. This creates what's called inelastic demand. Think of it this way. If bread costs $3 and rises to $4, you don't suddenly buy half a loaf. You need bread, so you pay $4. This pricing power is gold during recessions. The major consumer staples companies include Procter Gamble, Coca-Cola, Costco, Walmart, and Colgate-Palmolive. These aren't exciting companies, and that's exactly the point. Let's look at real performance data, because facts matter more than theories. During the 2008 financial crisis, the Consumer Staples Select Sector Spider Fund, ticker XLP, fell only 15.5% from peak to trough, while the S&P 500 plummeted 37%. That's a 21.5 percentage point difference, which in portfolio terms means thousands or even hundreds of thousands of dollars protected. In the 2020 COVID crash, consumer staples fell about 17% versus the S&P's 34% drop. Again, roughly half the damage. But here's what most people miss. It's not just about losing less. Consumer staples typically recover faster, too. In 2020, while tech stocks grabbed headlines, consumer staples quietly reached new highs within months, providing steady gains while other sectors remained underwater. Over the past 50 years, consumer staples have delivered roughly 10 to 11% annual returns, with significantly lower volatility than the overall market. That's the power of boring consistency. Understanding why consumer staples outperform in crashes gives you confidence to actually implement this strategy when fear is at its peak. There are 3 core reasons. First, revenue stability. When Procter & Gamble reports earnings during a recession, their sales might be flat or down just 2 to 3%, while other companies are seeing 20 to 30% declines. Predictable revenue means predictable stock prices. Second, dividend reliability. Most consumer staples companies are dividend aristocrats. They've increased dividends for 25-plus consecutive years. During market crashes, when stock prices fall but dividends remain stable, the yield becomes incredibly attractive. A 3% dividend yield suddenly becomes 4 to 5% as the stock price drops, pulling in income-focused investors. Third, defensive rotation. When professional investors sense trouble, they systematically rotate capital out of growth stocks and into defensive sectors. This institutional buying provides a floor under consumer staples prices. The psychological element is crucial too. In bear markets, investors crave safety and sleep-at-night holdings. Consumer staples offer that emotional comfort. You have 3 main approaches to investing in consumer staples, each with different risk-reward profiles. Option 1. Individual stocks. Pick 8 to 10 companies like Johnson & Johnson, Procter Gamble, Costco, or Coca-Cola. This requires research, but gives you control and potentially higher dividends. The risk is company-specific problems. Remember, even stable companies can stumble. Option 2. ETFs. The Consumer Staples Select Sector Spider Fund, XLP, gives you instant diversification across 30-plus consumer staples companies for a 0.1% expense ratio. This is the simplest approach, and what I'd recommend for most investors. Option 3. Mutual funds. Funds like Fidelity Select Consumer Staples offer active management, though they come with higher fees, typically around 0.70%. For most people, allocating 15 to 20% of your portfolio to consumer staples provides meaningful protection without sacrificing long-term growth. During clear recession signals, like inverted yield curves or consecutive quarters of GDP decline, consider increasing to 25 to 30%. Now, let's talk about common mistakes to avoid. There are 2 critical mistakes. First, don't overweight consumer staples during bull markets. They'll underperform growth stocks when the economy is strong. That's fine and expected. Second, don't confuse consumer staples with consumer discretionary. Nike and Amazon are consumer discretionary. They sell things people want but don't need. That's a completely different risk profile. Consumer staples are your portfolio's shock absorber. They won't make you rich overnight, but they'll keep you invested when everyone else is panicking and selling at the bottom. Next video, we're diving into dividend aristocrats, the elite companies that have increased dividends for 25-plus straight years. Subscribe so you don't miss it. And if you found this valuable, let me know in the comments what recession-proof strategies you want to see next. I'm Olivia, and I'll see you in the next one.